Well, I think a lot of this current sell-off is a combination of, fiscal stimulus has partially weared off at this point, right? So a lot of people got checks and things like that, and that's kind of, as we go months away from that, that starts to diminish. But then two, we're starting to see, for example, the Delta variant, right? So there's news about that, and it's not just a medical question; it's also the government responses to that, right? So there's kind of the medical question, but then there's also the economic question of what localities are going to lock down. How's consumer behavior going to change if we start to see that happen? And so I think we're kind of, the market is sort of freaking out a little bit about that and saying, okay, well, some of the fiscal stimulus is not as impactful as it used to be, and we're seeing some headwind to the economy. And so that reflationary trade that did very well for a period of time is kind of cooled off. So we see bond yields down, we see commodities down, we see cryptos down. We see some of the more cyclical stocks down, right? So even though the S&P 500 has been really strong, if you look at breadth under the surface, things that are more tied to the economy, like banks or industrials, they've been weaker. Whereas some of the mega cap tech stocks that are kind of economically agnostic, they've still been doing very well until today, when kind of most things are down. And so really, I think it's kind of a deflationary impulse. It also, I mean, it clears excess out of the market. So we've been taking away these kind of meme stock valuations and kind of clearing out a lot of that kind of excess, so that when this eventually bottoms, market participants can separate the wheat from the chaff for the next round of activity. 10-year yields have fallen pretty quickly. And it's interesting because that's despite the fact we've had inflation surprises to the upside, and so we've had kind of the treasury market say, we think this is going to be transitory. So the bond market seems to be agreeing with the Fed. Now it's complicated because the Fed is still buying a lot of the treasury issuance, right? So they certainly have their thumb on the scale in terms of impacting the supply and demand of that market. But even in that context, you do see varying private demand. Part of the treasury purchases, it's not so much kind of, there are traders buying it, but if you look at actually who's accumulating large amounts of treasuries, part of it is the pensions. So they're actually pretty big treasury buyers. Some of the banks, like Bank of America, have been buying treasuries, and then a little bit around the foreign sector, right? So we've had kind of foreign sectors not been buying treasuries as much as they used to, for years now, but there are periods of time where they kind of come back to the market, specifically when they can, when their FX hedged yields become better. And so, for example, if you're a Japanese or a German investor, there are periods of time where you can buy a U.S. treasury, hedge it back into your own currency, so you eliminate the currency risk and still get a higher yield than buying your own government debt. And so some of them will buy the treasuries in that way. And so right now, those are kind of the three big sources of demand besides the Fed. Yeah, so
Right.
what we're seeing right now is kind of characterized as a disinflationary move. So people are pulling out of risk assets into defensive assets. People are concerned about, say, how the new virus variant or lockdowns could affect consumer demand, could cool off inflation a little bit. For example, you could have less oil demand, as an example. And so generally in disinflationary environments, gold outperforms silver. And so, for example, if you look from the period from 2018 to 2020, you generally had gold, doing a lot better than silver. And then ever since that March bottom of 2020, we've been in this more reflationary environment. You've generally had silver outperforming gold. And so when you get these kind of deflationary or disinflationary pulses, it's not too surprising to see the more volatile metal silver go down more than gold. Whereas if you were to get a big inflationary impulse, I would expect to see silver outperform gold. So it really kind of comes down to that. Is it more of a deflationary, disinflationary environment, or is it a more pro-inflationary or stagflationary environment? I don't think the magnitude would be as large as March 2020. I think part of it is a medical question that I'm not very, likely to answer. But one thing I would observe is that I think, the more this repeats, the less kind of tolerance, the public has for this cycle, because, you can't, every time you lock people down, you have one of two choices. You either compensate them with printed money, or they just lose value, right? So if you tell a small business that they can't operate, you don't compensate them, then they, if they eventually go out of business, then basically Amazon takes that business, right? So we just kind of consolidate value up the value chain into the big mega caps. And so that's obviously not something that most people besides the corporations would want to happen. And so, it's pretty clear at this point that, the virus in various forms are going to be with us for a long time. we don't lock down the economy for the flu every season. And it's, obviously this virus is still somewhat more potent than the flu, so it's not exactly an apples to apples comparison. But when you compare it to other causes of death, so basically I've described it as we have to watch three variables. So we have to watch the medical variable, the virus, what variants are doing, how contagious are they, how deadly are they. Then we have to watch political responses to that. So are politicians doing lockdowns or not? And then we have to watch the public responses to those political responses to see, is the public accepting it? Are they on board, with that? Are they pro, locking down and trying to eliminate deaths as much as possible? Or are they kind of saying, we're sick of lockdowns, we're going to go protest against it, we want to vote those people out of office? So, and obviously you're going to have different answers in different countries or different states. Basically, I think it's a similar situation to March 2020, but we've had a couple of these waves before too, right? And so this is the one that's a little trickier because it's starting to impact even vaccinated people in some cases, and so it's a little bit different than those waves. But I think overall, it's the probability of complete lockdowns like the whole world experienced in spring of 2020, I think, is less likely the more this repeats. Yeah, so I wouldn't describe liquidity as a crisis, because there are signs of, you can watch like acute liquidity issues. So it's not any sort of thing like that we started to see in, say, late February or early March of 2020. So it's not to that level. But I do think that in terms of watching liquidity, it has topped and rolled over. So basically that we kind of hit maximum liquidity. In fact, there was so much liquidity that banks had to store that liquidity somewhere, and they kind of stored it in the reverse repo market. And so we kind of hit max liquidity, and then now we're kind of coming off of that high. And so some of the trades that were based on liquidity are cooling off to some extent. And then you can also combine that with solvency, where, say the Fed can't do anything about solvency, right? So if their business is failing, they can make rates cheaper, but they can't give money to people, whereas the fiscal authorities can, right? And so that's what they did, over the past year and a half. But if that's not repeating, then if there's lockdowns and there's no stimulus, for example, then more businesses are prone to fail because they have their cash flows interrupted and they're not being compensated. And so we'll see how that plays out. So I do think that basically, solvency and liquidity are both kind of cooling off here, which is a challenge for risk assets. So we are starting to see that sentiment's getting pretty negative. So I wouldn't be surprised to start seeing a bid. I think it's too early for me to say with any sort of conviction where this is headed, because again, you have to look at the medical aspect, which I'm not an expert on, but then also you have to kind of monitor the responses, the political and public responses to it.